QuantumScape stock is currently sitting at an exact price of $8.38 as of the market close on Thursday, May 21st, 2026, marking a significant 9.26% intraday surge. While a casual glance at a standard individual brokerage tracker might suggest this jump is just another volatile blip in a speculative sector, looking under the hood reveals a completely unexpected structural change. The actual driving force behind this massive upward move is not retail hype or speculative options volume. Instead, institutional capital is silently flowing into the company following its recent technology evaluation breakthrough with a third top 10 global automotive manufacturer. Major players are looking past the lack of immediate revenue because QuantumScape just recorded $11 million in partner billings, a stark shift proving that massive manufacturing giants are now actively paying to implement their equipment and engineering know-how. This specific development catches the market completely off guard because everyday investors have spent the last few years treating this asset as a permanent cash burn vehicle that would never make a physical product at scale. The broader market expectation for years has been that solid-state battery technology is permanently 5 years away from reality. If you browse active trading communities or check what people are saying on popular retail investing sites, the general consensus is that this business model is a black hole for capital. The sentiment is heavily anchored to the massive 46% decline the share suffered over the final months of last year, tumbling far below the previous 52-week high of $19.07. Retail market participants using a standard Robinhood app or tracking quick charts via the Robinhood trading platform often view this as a legacy placeholder, an asset that peaked during the blank check company boom and has spent years slowly fading away. The prevailing narrative claims that traditional lithium-ion technology is moving fast enough to make solid-state obsolete before it ever leaves the lab. This common perspective says the business will run out of cash before its specialized separator line can achieve mass production, forcing massive dilution that will crush early backers. The reality on the ground is completely different, forcing a massive tension between that outdated retail narrative and actual institutional progress. If you pull up institutional analytics on a professional Interactive Brokers platform or review detailed position changes via Interactive Brokers trading accounts, you see a completely different picture. The company has actually built out its highly anticipated Eagle Line production setup and has already transitioned into active startup operations. They are not just testing single-layer components anymore. They are actively fabricating early volumes of functional commercial spec cells. More importantly, their financial architecture is incredibly resilient for a pre-revenue firm. In their latest financial print, they delivered a surprise loss of just 16 cents per share, which handily beat the consensus expectations of an 18-cent loss. When you review their broader balance sheet on a Fidelity brokerage account or track their capital efficiency through Fidelity Investments tools, you notice they are sitting on an exceptional liquidity cushion of $904 million. This means their actual burn rate is fully covered for years, entirely invalidating the common bear thesis that an immediate liquidity crisis is imminent. This tension between what the public assumes and what the financial reports actually show is creating a massive divergence in how the stock is traded day to day. A massive wave of capital entering the space is using sophisticated self-investing strategies to slowly build positions. Retail traders frequently look at the wild daily swings and assume it is just noise, but if you monitor trading volumes, institutional accumulation has been quietly stepping in every single time the asset dips near its 52-week low of $3.80. Large-scale wealth managers utilizing automated platforms like Schwab Intelligent Portfolios or managing specialized Fidelity ETFs are recognizing that the structural risk profile has completely changed. The asset is shifting from a speculative research project into a legitimate industrial scaling play. This is precisely why the short interest is beginning to look incredibly trapped, as any positive operational update forces a sharp, violent rally like the 9% move we just witnessed. To understand why this is happening, we have to look closely at the underlying business model and how it functions compared to conventional manufacturers. The core problem QuantumScape solves is the limitation of traditional lithium-ion batteries, which suffer from limited energy density, slow charging times, and inherent safety risks. By replacing the volatile liquid electrolyte with a proprietary solid ceramic separator, they can utilize a pure lithium metal anode. This architecture drastically increases energy density, allows for incredibly fast charging, and completely eliminates the risk of thermal runaway. However, the bottleneck has never been the science. It has always been the immense difficulty of manufacturing flawless ceramic sheets at a commercial scale without any microscopic defects. This is where the market narrative falls apart, because critics act as though the company is trying to build massive multi-billion-dollar factories entirely on its own dime. In reality, the operational strategy relies heavily on a capital-light ecosystem model. They are actively collaborating with major global industrial partners, including heavyweights like Murata Manufacturing and Corning, to scale up their advanced proprietary separator production process. Instead of funding the entire global supply chain themselves, QuantumScape shares their engineering blueprints with equipment designs while retaining absolute control over the core intellectual property.
This allows their partners to deploy their own capital into specialized infrastructure, which explains that unexpected $11 million in partner billings reported this past quarter. Furthermore, their joint development agreements are not just vague, non-binding agreements. They are deeply embedded with Volkswagen Group's PowerCo division, moving systematically towards a real-world field testing and prototype vehicle programs. Comment below how many shares of QuantumScape you currently hold in your portfolio, and whether you trust their partnerships to bring this technology to market. When you analyze this through the lens of modern asset management, the stock fits into a very unique category within an individual brokerage profile. Many retail investors trying to figure out online investing look for easy wins on high-momentum platforms like the Robinhood app, or look at basic SoFi investing feeds to see what's trending. They often miss the deeper structural shifts that matter to long-term wealth accumulation. If you look at how sophisticated allocators use interactive broker stock trading tools, they treat an asset like this as a venture-style call option embedded within a liquid market. The downside is fundamentally capped by the immense value of the physical IP and the $900 million in cash, while the upside is massive if they successfully commercialize. This is a far cry from the speculative meme stock trading that characterized the company back in its initial listing days, representing a massive shift in shareholder composition. Looking forward, the strategic path for the rest of the year is exceptionally clear, with several distinct scenarios beginning to emerge. Management has firmly reiterated its full-year capital expenditure guidance of $40 to $60 million, along with an adjusted EBITDA loss projection of $250 to $275 million. Because their capital outlays for the initial production lines are largely completed, their primary financial focus is operational efficiency, focusing on improving equipment uptime and increasing line throughput. The primary catalyst to watch over the next 2 quarters will be the data coming out of their automotive partner testing lines. If these top 10 manufacturers validate the cycle life and safety metrics of the early production cells under real-world stress conditions, it will trigger a permanent re-rating of the equity value. At the same time, an entirely new structural narrative is quietly emerging that the broader market has not even begun to price in. During their recent executive commentary, leadership pointed out that their high-density, high-safety solid architecture is a natural fit for high-performance computing facilities and artificial intelligence data infrastructure. Modern data centers are facing severe power delivery and space constraints, and maximizing the energy density of localized backup systems allows for significantly higher computing rack density. This means the addressable market is no longer strictly bound to the automotive sector. It could easily expand into utility-scale storage and high-density industrial power systems. For investors managing a modern individual brokerage account or using a comprehensive SoFi robo-advisor setup, this optionality alters the long-term risk-reward math entirely. The ultimate resolution of the gap between market expectations and operational reality will come down to manufacturing execution. The bears are still betting that scaling up the manufacturing process will prove impossible, expecting the company to hit a permanent wall that destroys its cash cushion. The bulls, supported by recent earnings data and institutional accumulation patterns visible on major trading platforms, see a company that is systematically ticking off every single operational milestone it promised years ago. When you step back and look at the entire picture, the old view of this asset as a pure gamble is rapidly giving way to an understanding that it is a well-capitalized industrial engineering firm executing a highly technical roadmap. The contrast between the lingering negative sentiment from last year's price drop and the actual operational updates is exactly where the sophisticated investor finds structural opportunity, standing in sharp contrast to the superficial data driving everyday retail trading decisions. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video? Comment your thoughts. Share with your friends. Bell subscribe for more updates.